industry. Okay, but we have seen a decent amount of FII money coming into the markets in the past 6 weeks or so. What is the FII view, and where do you think the markets are headed from here? Aadil Ebrahim, investment manager of Bowen Capital Management, joins us. Aadil, good to have you on the show. Welcome. Well, that really is the question. You know, there was one rush of capital coming in the past 6 weeks or so after that movement out in December. What is the sense you are getting? Are fundamentals looking good, or is there simply, you know, more risk appetite out there for all asset classes?
Well, obviously the last couple of weeks, the flows into emerging markets has been very strong, not just India. You look at some of the other emerging markets in China, in Turkey, in South Africa, for example. The currencies have been strong, but at the same time you're seeing oil prices shoot up. So it is very strange how these currencies can be firm and the markets are very strong. I mean, obviously there's a lot of liquidity floating around with the U.S. quantitative easing program still going strong, and until that probably slows down, your markets may be strong, oil prices may still go up, but something has to break. At some point, something has to break. You may see oil prices crash, or you may see the markets fall. Both cannot keep going up like this.
Would it happen? Okay. Would it happen, therefore, that, you know, this risk asset party really waits for some very serious growth slowdowns in countries like India and China? I mean, after all, that's where the higher commodity prices are going to hurt.
Yeah, I mean, last time in 2008, oil peaked at 148 before there was a decline down to 60. But it had, before even the Lehman Brothers went bust, oil had already fallen from 140 to 100 as it was pricing in a slowdown in global growth. So you may run into something similar to what we experienced in the second half of 2008, where oil will shoot up probably past 148. Until it starts to affect global growth, the U.S. consumer starts slowing down, the import bill shoots up, currency starts to weaken, and global growth will slow down. No one has forecasted that. I mean, you may knock off another 100, 150 basis points off global GDP growth as oil prices shoot up. But right now, oil seems a one-way bet. I can't see it falling. I mean, the Libya crisis, to me, it's small change. I don't think there'll be any major disruption in supply from Libya, but I just think there's a lot of US dollars floating around that is sort of being invested into oil future market.
Aadil, let's talk about Indian market and a couple of sectors where we have seen some excitement of late. Let's begin with infrastructure. We've seen some of the stocks like IVRCL, Punj Lloyd, GMR, Lanco, some of the completely beaten down stocks. Some of them had fallen about 70-80%. They have seen quite a bit of rally of late. Was it just a dead cat bounce, or you think some of these stocks actually represent some value?
Well, I mean, some of the names that you mentioned, these companies have strong order books, and they probably have some sort of visibility in terms of revenue conversion. So I think the sell-off down 70-80% was obviously completely overdone, and maybe they have bounced back to more reasonable levels. For these stocks to continue to have upward momentum, you would have to see growth in order books, and right now I don't think we are seeing that. I mean, for example, look at BHEL, flat order book for the year, 10% for next year, and you may have other stocks like Larsen & Toubro disappoint on their full year order book. So the order book growth rate doesn't look too great at the moment. So for these stocks to keep going up, you have to see better order inflow. They could survive for another few years on revenue conversion, but then what happens after that?
Well, let's extend that then and talk about real estate, because that's also one space where there has been quite a bit of rally. Stocks like Unitech. Unitech in fact stands out from 36 all the way up to 48 or so. What about that particular sector? Would you say book out, or you think there could be some more rally in that?
Well, I mean, I've seen a lot of broker notes this morning saying short Unitech, it's rallied 40%, get out of it. There is no positive news out there. I mean, again, we don't invest in the real estate sector, so I wouldn't want to comment on valuations, but a stock like Unitech is still what, 60-70% below its peak from 2008, it's still down 20-25% this year, so maybe it's approached reasonable valuations. Like I said, I can't comment on specific valuations, but I said maybe a couple of weeks ago a lot of these stocks were beaten down way beyond fair value, so they're just coming up to reasonable value right now.
Okay, let me give you a more open question, Aadil. You've normally preferred in your Red Cobra fund the bigger stocks, the Infosys, the HDFCs, the Bajaj, though yes, there is the odd Jain Irrigation as well. Now do you see that you may have to look at the mid-cap basket? Is there anything that attracts you?
Yeah, our strategy is to be, is to predominantly stay with these blue chip large cap stocks that have consistently delivered shareholder value over the last 5 or 10 years. So you're looking at earnings growth of 20-25% per annum matched by shareholder returns. We see that with a lot of the large quality blue chips. Now you may be lucky and pick a couple of mid caps, but we run concentrated portfolios of 15-20 names. It's too much of a risk for us to go and pick that one mid-cap winner. For example, Jain Irrigation, we got hurt this year on it. So again, it's very, very difficult. So that's why we much prefer playing India through these high-quality large-cap stocks.
So, Aadil, what would be the call on IT as we head into the earnings season? Because you have some sort of investments in Infosys.
Well, I think the global growth environment looks okay. It looks quite decent. So I think in terms of visibility from the IT, from the Indian IT companies should be okay. So what people are factoring in 20% dollar growth, I think that's probably what they will come out as a guidance. And as long as global growth does not slow down from higher commodity prices, they'll probably end up beating that. From a margin perspective, probably another maybe 50-75 basis points decline in margins for the year, which is reasonable as they are investing for the future. I think the market shouldn't worry too much about margin decline as long as they are investing for the future. If there is margin decline from lower pricing and from greater competition, that's more of a concern. But with Infosys, the margin decline is really coming from currency and also from investing in the future.
The great Indian story is supposed to be the consumption story. You like any stocks in that space?
Well, we're playing that through Bajaj Auto, through HDFC. So that's really from higher disposable income spend would go ahead. We'll sort of transform to higher three-wheeler purchases to mortgage financing. So that's sort of how you want to play it. From the retail end, there are stocks we have owned in the past like Dabur or Hindustan Unilever. But I think with Dabur, for example, they've been very transparent in terms of the strategy of going abroad. They sort of feel the high growth in India is sort of over. So they're going abroad looking for acquisitions, and that strategy obviously can get risky. So we want to wait and see how that strategy sort of plays out. With Hindustan Lever, I think a lot of competitive pressure with Procter & Gamble. So I think best to stay out of that area for now.
All right, Aadil Ebrahim, we'll leave it at that. Thank you very much for joining us today with your thoughts.